All right, welcome back, traders. John Caruso here for the morning of October 11th. We're going to run back this morning's action here for you guys. So far, we've got the S&P struggling down here along 3,600. We're down 0.70%. We've got the NASDAQ down 1% right now. Gold prices are trying to make a little bit of a turn back to the upside. We're up 0.20% at 1677 in gold. And oil prices right now down 1.70% at 89.55. However, they are fighting off the morning lows. We saw oil prices dip to as low as 88.35 here this morning. Taking a look at stocks, we were actually getting an immediate term oversold signal here this morning. We saw stocks trade down as low as 35.80 in the S&P 500. Trend is clearly bearish. Momentum is clearly negative. But we were starting to see some signs of exhaustion down there below 3,600. So we're going to wait and see what happens from here. But keep that in mind. We are starting to see some modest signs of exhaustion on the downside in stocks ahead of really three-day event risk that we've got coming up. We've got PPI, CPI, and then retail sales and University of Michigan consumer sentiment coming at us in the back half of the week. So be on the watch for that. Taking a look at the gold market right now, 1677. It did hold last week's low in the overnight. We got as low as, I believe, 1668. 1666, I think, is a critical level for gold. We are starting to see that hold and fight off of those lows right now. We're at 1677. So we're watching gold right now and scouting out some long side trading opportunities. I'm having a hard time with having conviction of taking any position for longer than just a trade, maybe an intraday trade or a 1 to 2, maybe 3-day time frame in the market. So that's what we're looking at here. Obviously, looking back at yesterday, we saw Jamie Dimon issue another stark warning for the equity market, suggesting that stocks could even fall another 20% from here, suggesting that the next 20% would likely be much more painful and much more disorderly than what we've seen here to date. And to be honest with you, I'm not going to discount him talking about another 20%. I certainly think it could happen. Obviously, the next 100 to 150 basis points coming in interest rate hikes from the Federal Reserve, that is going to take the Fed funds rate into restrictive territory. So you obviously have to be mindful of that. I do think there's some concerns about liquidity in our debt markets. Naturally, we saw 2 weeks ago, the Bank of England came out relaunching QE for 30 days because they were having concerns about the UK gilts. The gilts are their bond market over there. And we could be seeing something similar potentially developing here in the United States. I am concerned about bond market liquidity. You have to remember that we have lost $60 billion in treasury purchases by the Fed. So the bond market has lost its biggest buyer, its biggest source of demand. We're not seeing the demand coming from central banks like we've seen in the past. We're certainly not seeing it come from the banks here in the United States. So bond market liquidity is something that we're going to be watching going forward. So that's all I have for you today. Best of luck out there. We'll catch you back here probably Thursday for the CPI number. Have a great day and go Tribe. Talk to you later.